Alistair, with this pullback that we've seen in the metals prices over the last 2, 3 weeks here, do you think that this helps alleviate the delivery issues and the pressure that we saw out of London?
No, it's a short answer. I mean, there's still a backwardation. There's still a backwardation in silver.
Mhm.
I mean, okay, it's not as extreme as it was, but I mean, and if you look at gold, I mean, gold never went into backwardation. But I think that's been, that's been better handled, if you like, by the establishment. The establishment now knows that gold is rising. I mean, if you want evidence of this, the LBMA's annual meeting, which was a week or two ago. I mean, they do what they always do. They ask all the attendees, what's your forecast for the price of gold and for the price of silver and all the rest of it, in 2026. And the average of all those expectations came out at just under $5,000. What that tells me is that the bullion banks, the refiners, and the various other members of the LBMA do understand that gold prices are going higher. Now, we needn't discuss whether they actually know what they're talking about in economic terms. I mean, we can only guess at that. But I think that behind this, there is a greater acknowledgement, if you like, that there are going to be supply difficulties when it comes to physical metal, for the simple reason that what happened earlier this year when the trucks were queuing up outside the Bank of England to take gold out of the vaults and ship it over to COMEX, this, I think, quite clearly signaled to the central banks, who basically store, I mean, all the gold in the Bank of England basically is central bank gold. I mean, a lot of it is leased, so technically it is actually owned by others, by non-central banks. But this is under lease. Now, the way in which this has worked in the past is quite simple. Bank of England turns around to, say, the Bank of Austria or whatever, and says, we can lease your gold. It'll earn you income. You'll earn 1.25% on it, whatever, which means that you will make a profit. It'll pay for all your cost of storage and all the rest of it. And it will be done by book entry transfer so that it remains in the bank, in the bank's vaults. And of course, it's got to be stored somewhere. So there's no point in taking it out of the bank's vaults. What it has meant is that it has provided liquidity for the London market in particular, where it's been hypothecated, re-hypothecated, re-hypothecated over the life of the lease. And of course, at the end of the lease, it hasn't been a problem because the bank could easily persuade the Bank of Austria to extend the lease, or alternatively find someone else to provide a new lease. Mm-hmm. But now all the central banks have been put on notice that if you lease your gold, you might lose it. Do you see what I mean? So I think the liquidity issue in London is actually very much in the back of the minds, if you like, of the bullion banks and the LBMA membership, mm-hmm. in terms of future liquidity. They are not short, and they are not short for that reason. I don't know that they're properly long. I don't think they are necessarily, because quite a lot of their long position, I think, will be with other paper. For example, through forward contracts. They would have bought forward, or alternatively, they would have taken out option positions and sort of capped their potential losses. Mm-hmm. And on top of that, of course, you have unallocated accounts. I would guess that the unallocated accounts are not properly covered. I think if you have a sort of rule of thumb that an unallocated account is probably only backed by 10% of gold. But as far as the bank's books are concerned, other than the unallocated accounts, I'm sure that the banks in London are long. But they've got to stay that way. And they realise the constraints, if you like. I think this is really what's going on in gold. The thing that upsets the whole system, of course, is when the general public decide that they want to buy gold or they want to buy silver, which they do generally through ETFs. And particularly with silver, if you look at the ETF storage in London, it's something like 80% of, or it accounts for something like 80% of the silver stored in the LBMA vaults. The other 20% is owned by others and includes some liquidity, perhaps, if you're lucky. So you can see that if, let us say, the general public decides we're going to buy some silver, which means that the ETFs go into the market and increase that proportion, if you like, of their silver in the London vaulting system, the squeeze has only just started. I mean, it really has.
The recent pullback in precious metals prices, particularly gold and silver, over the past few weeks has raised a question many investors are asking. Does this temporary correction relieve the pressure on the physical market, especially the delivery strains we saw earlier out of London? My short answer is no. Not at all. The underlying structural problem hasn't changed, and in the case of silver, it's still very much there, just hiding under a slightly calmer surface. There remains backwardation in silver. That is, near-term delivery prices are higher than future delivery contracts, something you should never see in a properly functioning market. That condition is a red flag, a clear signal that physical supply is tight. It may not be quite as extreme as it was at its recent peak, but make no mistake, the stress remains. Gold, interestingly, hasn't fallen into backwardation. But that's not because supply is abundant. It's because the establishment, the bullion banks, the LBMA, and the central banking nexus has done a far better job of managing the perception of stability. The gold market has become almost a political instrument, and those who manage it have learned to guide sentiment with remarkable skill. And there's no clearer sign of that than what we saw at the recent LBMA annual meeting. Every year they poll their members, bullion banks, refiners, traders, asking where they expect gold and silver prices to be in a few years' time. The results this time were astonishing. The consensus forecast for 2026? Just under $5,000 for gold. Now that's not a number from conspiracy theorists or doom bloggers. That's from the heart of the establishment. What it tells you is that even the people inside the system, those who profit from maintaining the illusion of stability, now accept that prices are heading dramatically higher. They may not understand the macroeconomic forces behind it, but they can feel the tension in their own business. They know that gold supply is tight, that physical delivery is harder to secure, and that the market has changed. Let's talk about that London delivery issue because it's one of the most revealing events of the past year. Earlier this year, we saw trucks literally queuing outside the Bank of England, waiting to collect physical gold from the vaults to ship it to New York, specifically to the COMEX. That's not normal. When the Bank of England's vaults start emptying into COMEX, it tells you something very big is happening behind the scenes. Why would they do that? The explanation is simple: liquidity. London's liquidity, to be precise. The Bank of England's vaults hold around 5,000 tons of gold, virtually all of it owned by central banks and sovereign institutions. But here's the key. Much of that gold isn't sitting idly in storage. It's leased. It's the hidden plumbing of the modern gold market. Here's how it works. Let's say the Bank of Austria deposits its gold at the Bank of England for safekeeping. The Bank of England, or rather the bullion banks operating through it, approach Austria with an offer. Would you like to earn some income on that gold? We can lease it out for you. They promise a tidy 1% or 1.25% annual return, enough to cover storage costs and make a small profit. The Austrians agree. After all, it's a low-risk deal on paper. The transaction happens by book entry. The gold doesn't leave the vault. It's simply transferred on the books to another party, a bullion bank, a refiner, or an ETF custodian. That gold is then used as collateral, lent again, or sold into the market. It's rehypothecated, sometimes multiple times, and each time it's lent, a new claim is created. The result? 1 real ounce of gold supports a pyramid of paper claims, 3, 5, 10 times over. Everyone assumes they own it, but in reality, they own a promise. It's the monetary equivalent of musical chairs. This system has worked for decades because it's built on trust. Everyone assumes that when the music stops, the gold will still be there. But this year, something snapped. When those trucks lined up outside the Bank of England, it sent a shockwave through central banks. It was a visual reminder that physical gold does move when it's needed, and that leases can become default risks overnight. Suddenly, central banks began to realize that leasing gold was not risk-free. If their leased metal is shipped to New York and delivered to satisfy COMEX contracts, it's gone. It's no longer in the vault, at least not their vault.
There has been a big shift, I think, in the Chinese authorities' approach to silver. I mean, in the past, they've basically accumulated silver. They have controlled the price. I mean, the suppression of the silver price, I put down to the Chinese. I mean, I think in 2023, they supplied, I can't remember the figures, but I mean, something like 200 million ounces or something, figure like that, to the West. And the interesting thing was that they supplied it to London, they supplied it to Hong Kong, they supplied it to Singapore, and I think there was somewhere else. I mean, these are all financial centers. These are not manufacturers. In 2024, the financial centers came out of it, and it was supplied more to countries like India, who manufacture solar panels and all the rest of it. I think it's probably stopped now. And if you look at the Shanghai Futures Exchange, the vaulted silver there has dropped very substantially. I'm told that the view is that if it goes down close to 500 million ounces, then we've got real trouble. Well, it's going that way. So, and interestingly, I mean, we wake up in the morning here in Europe and find that gold and silver are going better during Hong Kong's trading hours or Shanghai's trading hours. And we're trying to put a lid on it. That, as you can see today, I mean, we were up to what on gold we were up to what 4,020, and this afternoon, guess what? It's drifted back to something like 3,980. So the sellers, and they're not serious sellers at all. I think they're managers, if you like, rather than sellers. Managed to get it done by something like $40 off the top. We'll see what happens overnight again. I mean, there may be a bit of profit taking because obviously ahead of the weekend, the Chinese are wild punters too. I mean, when it comes to futures and things like that, they may well take some profits ahead of the weekend. So we might see some more weakness tomorrow. I don't know. But the underlying situation is that the stuff is running out of the vaults. And sooner or later, there's going to be a huge great conflict between the physical market and the paper market. The problem really with assessing what China owns is that they're very secretive about what they have bought. If you like, and I don't know the answer. I really don't know the answer. So what I've done is I've tried to work out on the information that we have what the answer is likely to be. My starting point in this was that the regulations appointing the People's Bank of China with the sole responsibility for acquiring the nation's gold and silver date from 1983. Now, it was at that time, Mao died in 79 or thereabouts. There was a massive inward investment going into China. And certainly from the early 90s onwards, the trade surplus was beginning to rocket as a result of all the factories that were being built in China by American corporations, mainly, and to a lesser extent, European ones. So, I mean, at the same time, we had a bear market in gold. I mean, a huge, great bear market in gold. And so this was an ideal time for the Chinese to pick up gold in particular.
What makes silver particularly explosive is the way it bridges two worlds, the monetary and the industrial. Gold is largely monetary. It sits in vaults. It anchors reserves. It's hoarded by institutions. Silver, by contrast, is consumed, literally burned up in solar panels, electronics, and industrial processes. The same metal that underpins the financial system is also being used up by the energy transition. That dual identity makes it uniquely vulnerable to shortages. Now let's turn back to London, where the problem is most acute. Roughly 80% of all silver held in LBMA vaults belongs to ETFs, especially the large ones like SLV. The remaining 20% covers industrial clients, bullion dealers, and a sliver of liquidity for day-to-day trade. That means if ETFs start seeing inflows, if the general public begins buying silver en masse, the vaults will tighten dramatically. We've seen this movie before. In 2020, when retail investors organized online and began buying silver through ETFs, the inflows were so large that the LBMA had to issue a press release reassuring the market that there was plenty of silver. Behind the scenes, they scrambled to source bars from anywhere they could find them. That was the first silver squeeze. The second one will be much larger. Right now, we're at the early stages of that process. The ETFs have already begun to absorb a greater share of the remaining stock. If that continues, we could see a genuine physical shortage emerge. Remember, the LBMA vault system isn't just a storage network, it's the foundation of global silver pricing. If the vaults run low, the credibility of the entire paper market collapses. And this is precisely why the pullback in price doesn't matter. A $2 or $3 dip on the charts doesn't rebuild inventories. It doesn't conjure new supply. All it does is give the illusion of relief. The underlying scarcity remains. On the gold side, the psychology is shifting. The LBMA members who once dismissed gold bulls as fringe voices are now quietly admitting that the market's changing. When an industry's own insiders forecast 5,000 gold, that's not optimism. It's damage control. They're managing expectations before the repricing becomes undeniable. And this isn't just about price, it's about the changing role of gold in the global system. For decades, gold has been treated as a relic, something that central banks hold for tradition's sake. That narrative is dead. Central banks bought more gold in 2023 than in any year since records began in 1950. They're not buying it for nostalgia. They're buying it because the fiat system is in terminal decline. Western central banks talk about soft landings and inflation control. Meanwhile, their Eastern counterparts are quietly converting reserves into metal. The People's Bank of China, the Reserve Bank of India, even smaller nations in the Middle East and Africa. They're all stockpiling gold. Some of them are doing it openly, others through opaque channels like sovereign wealth funds. And as central banks hoard gold, private investors are following. ETFs are one route, but increasingly, people want physical possession. They're waking up to the reality that paper gold is not the same as physical gold. The phrase, "if you can't hold it, you don't own it," has become a kind of mantra among serious investors. The problem is, the system wasn't built for everyone to demand delivery. It's built on fractional reserves. The COMEX, the LBMA, the ETFs, they all operate on the assumption that most holders will settle in cash, not metal. But when confidence wobbles, that assumption dies. The London system in particular is dangerously overextended. The multiple layers of leasing, hypothecation, and derivatives have created an illusion of depth. But underneath, it's wafer thin. When one participant, say a central bank or a large ETF, decides to take delivery rather than roll the lease, the whole chain tightens. And that's exactly what we're seeing. The trucks outside the Bank of England were not an anomaly, they were a warning. The central banks now understand that leasing is a trap. They know that earning a bit of yield isn't worth losing the asset altogether. Once that realization spreads, the supply of leasable gold evaporates, liquidity dries up. And when liquidity dries up in the bullion market, prices don't just rise, they reprice. We're entering that phase now. The LBMA forecast of $5,000 gold isn't a guess. It's a whisper from insiders who know the supply lines are fracturing. Silver will follow, but more violently, its smaller market size, its dual demand base, and its thin inventories make it a coiled spring. A mere $5 billion of new investment capital could move silver $10 higher. That's how tiny the market is relative to global capital flows. Now consider this. If ETFs, industrial users, and retail investors all increase demand simultaneously, there's simply not enough silver in London to go around. The system would be forced into default or cash settlement. The paper price would become meaningless, and physical premiums would skyrocket. We've already seen hints of this dynamic. Premiums on physical silver coins and bars have widened dramatically compared to spot prices. That's not just dealer greed, it's market stress. When you can't source 1,000-ounce bars easily, retail product prices go parabolic. So, what happens next? We're witnessing the slow-motion end of the Western gold and silver pricing system. The old model, dominated by London and New York, is being replaced by a new one led by Asia. Shanghai, Singapore, and Dubai are emerging as physical hubs where price is determined by delivery, not derivatives. This transition won't happen overnight, but it's well underway. And it's no coincidence that prices tend to rise during Asian trading hours. The physical buyers in the East are setting the tone. The paper traders in the West are just reacting. The pullback of the past few weeks is just noise within that larger trend. The structural shift is irreversible. The bullion banks know it, the central banks know it, and increasingly, investors are waking up to it too. Gold is not rising because of speculation. It's rising because trust in the financial system is eroding. Silver is not volatile because it's erratic. It's volatile because it's running out. So when people ask whether the pullback has alleviated pressure, I say this: price is not the pressure. The pressure is in the vaults, in the unallocated accounts, in the short leases that can't be rolled over. The pressure is structural and it's growing.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.